Previous week, we covered index funds, and a lot of you asked the same question in the comments. What about ETFs? Are they the same thing? Which one should I actually buy? Great question, and honestly, the answer is more interesting than you'd expect. Because here's the thing, ETFs and index funds are more similar than they are different, but the differences that do exist could actually save you thousands of dollars in taxes over your lifetime. So let's break it down. ETFs versus index funds. What's actually different, what's exactly the same, and which one is right for you? Let's start with what most people get wrong. ETFs and index funds are not opposites. In fact, an ETF can be an index fund, and an index fund can be structured as an ETF. Both of them do the same core thing. They pool money from thousands of investors and buy a basket of securities that tracks an index, like the S&P 500 or the total U.S. stock market, or bonds. Both are passively managed, meaning no one is sitting there making active decisions about which stocks to buy or sell. An algorithm just follows the index. Both have very low costs compared to actively managed funds, and both have delivered strong long-term returns that beat the majority of professional fund managers. So if you're wondering whether one is fundamentally better than the other, the honest answer is not really. The difference is in the details, and those details actually matter. Difference 1. How they trade. This is the biggest structural difference. ETFs trade on stock exchanges throughout the day, just like individual stocks. You can buy at 9:30 a.m. and sell at 2 p.m. if you want. The price changes every second the market is open. Index mutual funds are different. You place your order anytime during the day, but your trade only executes once, at 4 p.m. Eastern Time, when the market closes. That's when the fund calculates its price. For long-term investors, this difference doesn't really matter, but it's worth knowing. Difference 2. Minimum investment. Most ETFs can be bought for the price of a single share. VOO, Vanguard's S&P 500 ETF, trades at roughly $200 per share. Some brokers even let you buy fractional shares for as little as $1. Index mutual funds often have minimums. Vanguard's index mutual funds start at $3,000. Fidelity and Schwab have no minimum. But not all index funds work that way. Winner for beginners with less cash, ETFs, or Fidelity and Schwab mutual funds. Difference 3. Tax efficiency. This is the most important difference for anyone investing in a regular, taxable brokerage account. ETFs are generally more tax efficient than index mutual funds. Here's why. When you sell shares of an index mutual fund, the fund manager may have to sell some of the underlying stocks to pay you out. That can trigger capital gains taxes, not just for you, but for every investor in that fund, even ones who didn't sell anything. ETFs work differently. When someone sells ETF shares, those shares are exchanged between buyers and sellers on the market. The fund itself usually isn't involved, so it rarely has to sell underlying stocks, which means it rarely triggers capital gains distributions. Bottom line, in a taxable account, ETFs give you more control over when you pay taxes. But, and this is important, if you're investing inside a retirement account, like a 401k or an IRA, this tax difference is completely irrelevant. Both work equally well there. Difference 4. Automation. This one surprises people. Index mutual funds let you set up automatic investing of exact dollar amounts. Want to invest exactly $400 every month on the first of the month? Easy with an index mutual fund. Set it and forget it. ETFs are trickier for automation because they trade in shares, not dollar amounts. $400 divided by a share price that changes every day doesn't divide neatly. Most major brokers now offer fractional ETF investing, which solves this, but index mutual funds still have the edge for true automation. One more thing worth mentioning. Fidelity offers something unique. index mutual funds with a 0% expense ratio. Zero, nothing, free. They're called FZROX, the Fidelity Zero Total Market Index Fund, and FZILX, the Fidelity Zero International Index Fund. No expense ratio at all, no minimum investment, only available through Fidelity. For someone who wants the absolute lowest possible cost and is already using Fidelity as their broker, these are genuinely hard to beat. Here's the honest, simple answer. If you're investing inside a retirement account, like an IRA or 401k, either one works perfectly. The tax difference doesn't apply. Pick whichever your broker makes easiest. Fidelity Zero Funds are a strong pick here. If you're investing in a regular taxable brokerage account, ETFs have a slight tax edge. VOO, VTI, or FXAIX are all excellent. Most brokers now offer fractional shares, so automation isn't the barrier it used to be. If you want complete simplicity, set it and forget it automation, index mutual funds, especially at Fidelity or Schwab, where there's no minimum. $400 a month, auto-invest, never think about it again. The real answer for most beginners, it doesn't matter that much. A low-cost index fund or ETF, either one, will dramatically outperform most actively managed investments over the long run. Don't let this choice become a reason to delay investing. Pick one. Start. That's what matters. One last honest warning. Some people hear that ETFs trade like stocks, and they start trading them like stocks, buying and selling based on daily news, trying to time the market. That's the exact opposite of what ETFs are designed for. The entire advantage of index investing, whether ETF or mutual fund, is that you hold it long-term and let compounding do the work. The moment you start trading in and out, you're adding transaction costs, triggering tax events, and almost certainly making lower returns than if you just held and did nothing. Buy it, hold it, leave it alone. That's the strategy. So here's where you stand. ETFs and index funds are more similar than different. Both track indexes, both have low costs, both beat most professional fund managers over the long run. The differences come down to how you trade them, your tax situation, and whether you want full automation. Every week on this channel, we break down one money concept, clearly, honestly, no jargon. If this video helped you, subscribe so you never miss one, and comment below, are you going ETF or index mutual fund? Tell me which one you're leaning toward.